Our last panelist is Arturo O'Connell, the now advisor to the Presidency, the Central Bank of Argentina, and several times a member of that bank's board.
Well, it's Friday the 13th. In Spanish we say, Viernes 13, no te cases ni te embarques. Mean Friday the 13th, don't marry yourself, neither catch a boat, neither, I would add, speak right before lunch. But I do my best. So, just to rush into a few of the main arguments I want to make, and then just in case the 15 minutes go away, let me say 2 or 3 things. I'm going to speak about cross-border debt at the experience of periphery countries, the expression that, if not invented, was widely circulated by the Argentine economist Raúl Prebisch, who was the first general manager of the Central Bank of Argentina, which was created under the advice of Sir Otto Niemeyer, previously at the Treasury and then at the Bank of England. Then, first thing, debt equals credit. For each debt, there is a credit. For each debtor, there is a creditor. So, when we speak about debt problems, at least when they go beyond some amounts, then a debtor problem is also a creditor problem. And a debt crisis is a creditor's crisis at the same time. It takes 2 for tango. While repayment goes on, the dance is very pleasurable. When repayment stops, then they go opposite ways. This is my first point. I mean, creditors do have a role in this whole question. And in fact, more and more over the last 30, 40 years, as periphery countries' paper has become an asset class. And so I visualize what is normally called a debtor's crisis as an asset bubble. It's just one more asset bubble. It's a bubble in this asset class, the asset class of periphery paper. And then it would apply to that bubble what we all know about asset bubbles. What was the reasons behind it? Why was it that banks enter into the bubble? Why was it that the regulatory authorities didn't stop them to do it? And then why, when the crunch comes, then it's all on the periphery country to sort it out? The other thing I want to say is also a very banal thing, that credit and debt relationships are individual relations. There is a creditor and a debtor, normally a financial institution, and the debtor might be a government, but not the whole country in principle. Whole countries are not creditors, neither debtors. It might, because of an accumulation of a myriad of credit-debt relations, it might then be construed as a country-to-country link. And then the important thing to keep in mind is a very also banal thing, that the interests of individual creditors, or individual debtors also, but particularly of individual creditors, do not necessarily agree with the interest of their countries at large. in fact, there are enormous externalities in this game. So now that I've said what are my main ideas, let me say a few more detailed things. We have had various waves throughout history, but particularly beginning in the 1970s, waves of private capital flows that have gone through a well-known cycle. There was one in the 70s that ended up in the early 80s. There was again one in the beginning in the early 90s. And then we ended up in all the various tequila, Asian, Russian, etc. crisis. Then there was a wave between 2003 and 2008. And we are witnessing maybe the end of a tiny little post, so to speak, subprime mortgage crisis wave. Now these waves are mainly dominated by events in the advanced economies, either because of monetary policy, that, for instance, the 1970s or the early 1990s were dominated by very low interest rates, and then creditors, investors looking for a more profitable placement of the resources. Or it might be like there is a literature which I find quite fascinating that got started by various authors placing the emphasis rather than on current account balances and imbalances, on global imbalances, on studying gross capital flows. And there you see there's contributions by Borio and Disiatat from the BIS, and lately by Professor Shin. And Professor Shin now has produced a couple of papers speaking about, one should speak about global banking glut and not global savings glut, which is the expression that Mr. Bernanke has been using. And in this global banking glut, what Professor Shin and by himself and then with Ms. Bruno have lately been studying, what dominates it, it's the leverage cycle of the big banks. And this leverage cycle is dominated by perceptions of risk. And they use VIX as a proxy for perceptions of risk. Now, when these cycles were dominated by interest rates, like in the 70s or early 90s, they tended to be somehow, for the periphery countries, somewhat counter-cyclical. At the moment of recession, then you had low interest rates, you have a flexible monetary policy. At the very moment when, because of the recession, primary product prices were coming down and there was little demand for the exports or reduced demand for the exports from periphery countries. So these capital inflows, for all the negative sides of them, in a way played a kind of compensatory role. You had less export demand, lower commodity prices, but then you had some kind of automatic finance, at least of your balance of payments, building up a cycle that ends always in a crisis, but still you had that. Now, Professor Shin's way of looking at it, which I find quite attractive, is now that in fact, rather than having this compensatory role, it kind of added up to the consequences of the crisis. And you could see capital flows in 2008 and 2009 stopping to developing countries, to periphery countries, because precisely of the way in which he considers the thing dominated by this leverage cycle, in its turn dominated by the perception of risk, but not of risk in the periphery countries, but of risk in general. So we have these various waves, and where the push factor predominates. It's conditions in the countries in which credits originate that dominate these several waves, not the pull factor of the situation in the periphery countries. Now, this cyclical behavior has brought big instability to periphery countries. This instability, and this has been quite well studied, brings all kinds of negative consequences for the periphery countries, but also by themselves. I mean, there is quite an interesting literature that came out, a lot of it from the research department of the IMF, that on the other side is favoring this opening of capital accounts and capital flows. Out of the research department of the IMF came several important papers, but from other people like Professor Eisenman, showing that in fact capital flows to periphery countries are not a necessary condition for growth. In fact, in the Rajan and several other guys' paper, Rajan was head of the research department of the IMF, and eventually in a more polished version was published in Brookings Papers on Economic Activity. They show actually a negative consequence of capital flows to periphery countries, not only because of the cyclical thing, but because of these floods, something that now many people and the IMF also have become more conscious, that these surges in capital flows to periphery countries bring about asset bubbles in the periphery countries, bring about overvaluation of exchange rates, all kinds of negative things for the periphery countries. At the moment of crisis, then the periphery countries is supposed to produce a balance of payment surplus. And now, balance of payments up to square all over the globe, although we know statistically that there is a black hole there in the statistics, and they don't up really to zero. But balance of payments up to square all around the world. And so for the periphery countries to develop a surplus, in the non-periphery countries, a deficit has to be run. And this, at the time of the 1980s crisis, about, if I have time, I will speak more, was quite well studied by two exercises. One with the multi-mod model of the IMF at that time, and another by the Link project model. In March 1988, at the meeting of the interim committee of the IMF, the World Economic Outlook was presented. At that time, pre-internet, it was a mimeograph thing, and was distributed previously at the board and then at the interim committee meeting. It carried an appendix in which people at the research department with the multi-mod model had simulated the following scenario. What would happen if the, so to speak, creditor countries, for over the period of 5 years, do finance by issuing their own domestic debt in their own countries, do finance half of the debt service of the indebted countries of that time, mainly Latin American countries, the Philippines, Cote d'Ivoire, and things like that. And the result was quite extraordinary. There was a multiplier of 1.5 over a 3 years period of the national income of the United States and of advanced countries in general. So it was not only that countries paying debt service were better, but their improvement improved the economy, the world economy in general, and improved the economy of the advanced countries. So that, in fact, there was a mutual advantage rather than a matter of conflict between the advanced countries and the periphery countries in coming to some kind of refinancing through public means of the debt service. The interesting side of this story is that this appendix was taken away from the printed edition of the World Economic Outlook of March 1988. Although I myself made my presentation, I was sitting at the interim committee, and my presentation, the presentation from my country, Argentina, I made it precisely on this point. Is we had this appendix that was showing that, then how to deal with the debt problem of that era. It was a totally different way to deal with it. So let's go back a little bit to this 1980s crisis of the periphery, because I think it has a lot of lessons like this one, for instance, for now other peripheries that have come up in the world. Previous to that, and it's quite interesting because the 1980s crisis was the first time that there was real discussion of a debt crisis. There had been quite a lot of debt crisis before in the post-war period, but they were mainly government-to-government debt, and were handled by the Paris Club on the one hand, and by some lending from the IMF. And some countries had a very hard time, for instance, Peru at the end of the 70s, etc. It wasn't easy for them. Why was it that the 1980s crisis, which was the end of one cycle, the cycle of recycling of petrodollars, was labeled as the debt crisis? Because, in fact, it was a creditors' crisis. Because the 9 largest United States banks had lent 2.8 times their net worth to these countries. So had them been unable to just pay 30% of the debt, they would have collapsed all around. What I used to label the nuclear option. I mean, there were some people, and we had this Cartagena consensus, thinking that we were bunching together with all the other Latin American countries, Angel Gurria, who was here, and me and a guy from Brazil. We met in Cartagena with other people, and there were photos of the 3 big debtors that we were bunching together and developing a cartel of debtors. In fact, what was developed was a cartel of creditors, the famous steering committees. And then, for a few weeks' time, Mr. Donald Reagan, the Secretary of the Treasury of President Reagan, said, well, this is a question to be handled by the markets. And General Pinochet, in the case of Chile, 80% of the external debt was private debtors. And so he said also, market-friendly policies. So it's a question that the market has to sort out. Well, Mr. Reagan lost his job. General Pinochet didn't lose his job, but assumed the private debt and renegotiation of the private debt. There was a lot of public interference in the process, particularly by the government of the United States, and I would say because it was the solidity of the financial system of the United States was at stake through the international financial institutions, through the IMF, but fortunately above the International Monetary Fund. In fact, most of us, and in the case of Argentina, I went through that experience, we could find it more easily to come to an agreement with Mr. Baker and Mr. Volcker than with the officials of the IMF. And in fact, we had the memorable for us episode in which one day the IMF in 1985 passed a program for Argentina, which was an orthodox, well-known, conventional program. The day after, it passed another one, which had some heterodox elements in it, because the government of the United States, both the Treasury and the Federal Reserve, thought that that was much more attractive proposal. And obviously the bureaucracy of the IMF were furious, but there the impact that led Mr. Bhagwati to speak about the IMF being dominated by the Treasury Wall Street complex, in fact worked favorably for many of the debtors. It wasn't the case of some Northern European countries. I visited many of them, and they were totally against this. Now, the strategy that was developed, muddling through from case to case, because that was, yes, one big principle, not to tackle the debt problem as a global problem, to tackle it case by case, country by country, muddling through, which was the expression, muddling through these cases by cases. What was the strategy that was developed? What I call the revolving door strategy. Some fresh money from banks and some money from the IMF at the beginning and then from the multilateral development banks was lent to the indebted countries, always much less than interest service, and the rest was the effort that the indebted countries had to do. And this way, the United States banks could show that their loans to these countries were performing. And this muddling through was also combined with the short leash attitude, mainly by the fact that the IMF controlled every quarter if countries were complying with the conditionality of the IMF, which introduced extraordinary instability. You imagine every quarter a mission of the IMF in the country deciding if you had complied with the conditions or not, the kind of instability of it all. So that was the main strategy, muddling through, revolving door, short leash. Now, as the result of the multi-mode exercise showed, for the economy at large of the United States or for the advanced countries, this was not a good strategy from the point of view of the whole economy. So that this strategy of the revolving door was good for the banks. The banks, after a few years, managed to accumulate sufficient loan loss reserves. And so they rebuilt their balance sheets. And so they could, by 1987, Citibank kind of announced that they were ready to sell part of their portfolio in the secondary market at big discount, because they had built up the balance sheet in such a way that they could risk this discount. But for workers, for non-financial business in the United States, it meant a loss of jobs, profits, and output, because countries indebted countries had to make room for debt service and not import, so that exports were less, and more exports from our countries had to be accepted. So the revolving door strategy placed all the emphasis on sorting out the situation of the banks, and this was crowned with success. I mean, by the late 1980s, the banks have gone out of this risky situation in which they found themselves at the beginning of the 80s because of the madness of the amount of lending they had done in the late 70s and in the first years of the 80s, which came to an end when Mr. Volcker decided to enormously increase interest rates, which was again what happened in the early 90s. Low interest rate by Mr. Greenspan to sort out problems of the banks in the United States. In February 94, interest rates in the United States started going up. Only a few months afterwards, you had the tequila crisis. Now, what I have tried to show is that then there is a possibility of a coming together if we can agree on some kind of burden sharing, really internationally. Nationally, I've shown that even for advanced countries, it wasn't a good deal at that time, and I think this has lessons for the situation in Europe right now. Obviously, in indebted countries, that wasn't a good thing. We had the lost decade of the 1980s. We had an enormous transfer of resources to the wealthy people in our countries that had placed an enormous amount of money abroad. And they transferred through various means in the various countries, they transferred their own private external debt to government. So the government had to produce resources to pay for debt service, also the private sector. And in many countries, when, for instance, in Chile or Venezuela, the exports were in the hands of a government-owned enterprise, the domestic transfer was easy because Codelco, the copper company, had the resources and had transferred it to the government. The government could pay for that. And in Venezuela, the same. In Brazil and Argentina, it wasn't like that. It was exports when they handled the private sector. And to manage to produce the domestic transfer was much, much difficult than the external transfer. Most of these countries in just 1 year time, by 1983, most of these countries had a current account surplus. The problem was really the domestic transfer problem, the transfer from the private sector to the government sector. Now, in the last few years, after all these crises with many things that turn up, there were two changes. First, the periphery countries in general learned the lesson. They started accumulating reserves. They started introducing some kinds of capital controls, controls on inflows of capital. And if I had time, I would say something about the hypocritical position of the IMF as to capital flows and controls on capital flows. Because even in last year's meeting, there was speech about that the IMF had changed opinion. The IMF cannot change opinion. Articles of Agreement, Article 6, Section 3 says that the countries have the right to introduce capital controls. So it's not a matter of opinion. You have to change the Articles of Agreement as they tried to do back in 1997. In fact, what the IMF is doing is try to place Article 6, Section 3 under Article 4, under surveillance, and so introduce conditionality over the introduction of capital controls. It is like that. For all the beautiful talk, mainly coming from the parts of the staff about that. Well, it would take me half a minute to say what are the reasons for this stubbornness of not coming to a more equitable kind of arrangement, which would be of mutual advantage, of the interest of the advanced countries also. It's not Keynes. I mean, Keynes spoke about the generosity when he spoke on the economic consequence of the peace, and he said, what is happening to these countries is that to produce annual service, this is not up to the progress of humanity. It doesn't square with present-day progress. So then we should be generous, because this would not keep going a lot of time. It's not a question of generosity. It's a question of mutual advantage. Now, why? Why is this not taken up? Well, first of all, it might be just the silly thing of a fallacy of composition, that a private virtue, austerity, saving, etc., it's transformed into public vice, recession. This is one possible thing. Then there is the short leash, as my good friend Oscar Ugarteche from Peru, but his professor in Mexico, has written recently a nice paper about comparing Latin America with Europe. The short leash was a big temptation to use conditionality to make the indebted countries adopt Washington Consensus, neoliberal, whatever. Washington Consensus, let me say a word, John Williamson's book was much more moderate than anything that has been applied to our countries. Let me be fair to John. And the third thing is obviously the power, as it happens with the subprime mortgage crisis, as it has happened now with the crisis involving advanced countries, which is the power of banks to dominate the ideas. It's more than the sheer power of controlling the bond market so that governments are afraid that they cannot refinance. All governments have to go into the bond markets, even those that are not highly indebted, to refinance part of the deficit or debt. But it's also the capacity to produce these ideas, these metaphors that Bruno Bettelheim explains so well about child stories, how they involve very powerful metaphors. It was the crony capitalist in Asia. Now it's responsible countries in the periphery. And the banks, those responsible banks were lending to irresponsible people. Those responsible supervisors of those banks were happy to allow those banks to lend to irresponsible people. So where the responsibility lands. So my final call is, it's not a question of generosity, it's a question of mutual advantage. If such idea, which would be crucial even politically, a few people today spoke about that, which for me it's an obsession, because I worked for a lot on the 1930s and the 1920s. And I'm very much afraid when I see in Europe extreme right-wing forces coming up. So it's not only mutual advantage from an economic point of view. These questions have to be sorted out smoothly. Otherwise, adventurers of the worst kind might cut the mind of people. 2 days ago, I read Le Monde. 26% of young people from 18 to 24 years of age are going to vote for Marine Le Pen in France. Well, if such solution is not applied, what we will have is a series of defaults. And chaotic defaults, or maybe we can learn from the Argentine lesson, which wasn't a chaotic default. At the very beginning, it was a chaotic default, but then there was a renegotiation and an offer which involved a haircut of about 2/3 of the face value of debt, which was accepted by an overwhelming majority of the creditors. We still have problems in courts by the vulture funds, but still that was an example of the way in which things can be done. Debt has to be reduced. There's no other way. And it has to be reduced to end with this problem, which it has economic advantages for everybody around the world, but also politically, not only for us in the 80s, we were coming, all of us, out of terrible dictatorships. So these young democracies were under this. But Europe also has produced 2 world wars. I recommend you to read Mr. Massower's book, Dark Continent. That dark continent is Europe. Thank you very much.